Hi, everyone. Welcome to the webinar today, and thank you for joining. It is right at the top of the hour. We're going to go ahead and get started. Uh, Webinar for topic today is for top financial planning and tax strategies for dental practices. My name is Elliot Tracy. I lead our dental sector here in at Sorren and looking forward to having everybody on today and going through these topics and kind of giving you some resources and hopefully answer some questions for you. So today, really, what we're talking about, if I had to pick an underlying theme, is how can we keep more of our wealth that is generated within the dental practice, which is obviously a lot easier said than done. Right now in our current market, we're seeing rising staffing costs, increased supply expenses, insurance reimbursement pressures, inefficiencies of tax structures, and really poor cash flow management being one of the major pieces. And so, as you can see on this slide, revenue is not wealth. You can do two, three, four, $5 million in revenue and still see a very minimal bottom line and net cash flow for a number of different reasons. So how do we do a better job of tracking those dollars and seeing where everything's going and really improving on that profitability, but two, keeping more cash in the practice. So that would be our main goal for today. I'm hoping that once we get through all these slides, you'll have some tools to take you in a direction where the practice is going to be, like I said, more profitable and see more cash flow. So what is true profitability? So profitability are going to be your collections minus your clinical overhead, minus your administrative overhead, debt service, and then taxes. So that's truly the cash flow that you're generating in the practice. I've seen a lot of financials over my years of doing this. I've had 15 plus years working with dentists, and that final figure after everything is subtracted, what true wealth have you created from your practice? What true cash flow is there? That can be very different. And the profit and loss statement is not always indicative of that item for a number of different reasons. So we'll talk about that. But really, those three main focus areas today is knowing your overhead, improving operational efficiencies, and reducing, in this case, we're referring to as tax drag, but we're looking for ways to be more efficient with our dollars, is another way that you can say this. So ways to reduce taxes, but be more efficient, use it wisely. So talk about overhead first. So let's talk about some key benchmarking ratios. There's a few on here that actually aren't included. I'll discuss a couple of those, but some of the big ones that we talk about a lot because they have, one of the biggest impacts to the profit and loss statement is staffing, dental supplies, lab costs, and then a few others that are outside of that overhead but are really key benchmarks. So staffing costs, you can see here 28 to 32%. I would tell you in today's day and age, years and years ago, 28% of your collections was really what we were shooting for pretty consistently. If you were over 28%, then we might say you're potentially overstaffed or we're not producing enough for the staff that we have. Those are really two of the main indicators that we would be looking at and talking about. And like I said, in today, 32% is not abnormal. 32% is something that could happen pretty consistently with increasing staff costs. And a lot of that has come obviously out of COVID. We're 4 or 5 years removed, but we're still seeing the after effects of rising staff costs. And it's something that we really need to keep an eye on. It's the biggest line item on your profit and loss statement is your staffing cost. And this is everything from your retirement plan benefits that are being offered, health insurance, other employee benefits, the payroll taxes. What is that all in cost for your staff? Um, so ideally, we'd like to see between 28 to 32%. And if we can get there, you're going to see some profitability to that bottom line. Dental supplies and lab fees are two things that I look at almost as one, but are separated. And the reason I look at them as potentially one is when you combine the two, we want to see between that 10 to 14%. And if you're in that range, you're doing a good job. Supplies, a lot of times, may be a little bit higher, and lab fees may be a little lower, but the two of them generally are going to balance each other out. You might also have the inverse. Lab fees are going to be a little less, and your supplies may be a little bit more, depending on what you're doing in the practice. And a lot of this does depend on specialty. These figures right now are very much from a general office perspective, but some of these ratios can be, they get tweaked depending on the specialty. So right now, and I could have mentioned that right out of the gate, this is more for a general practice than this is a oral surgery office, right? So oral surgery generally is going to have a lower overhead percentage as a percent of their collections. The dental office is usually not necessarily higher, but these items are going to take up more of that overhead percentage. So also in a general office, the hygiene production needs to be between 25 to 35%. The hygiene production is really going to drive the production of the dentist and create more profitability. And that's extremely important. So need to have good hygiene production. Dentists should not be doing a ton of hygiene. It should be handled by the hygienist, obviously. And and with that being a good percentage, it's going to drive everything else. Um, EBITDA margins, for so those that may not know what EBITDA is, that is the acronym is earnings before interest, taxes, depreciation, and amortization. So looking at EBITDA, it's taking a look at that profit and loss, adding back the interest, adding back the taxes, adding back depreciation and amortization. We like to see that between 25 to 35%. Please note that this is net of the doctor and provider salary. So this is after those items. Um, EBITDA and overhead are two different things. So when I talk about overhead, I generally use it in the term of your major categories, your staff compensation, benefits, dental supplies, lab costs, marketing. Marketing's generally 1 to 3%. We like to see 1 to 3. We should always be spending something on marketing so that we can get new patients in the door. Occupancy, so that's your rent, your utilities, and repairs and maintenance on equipment, the cost of the facility itself. And then the last category is the general and administrative category. So that's what I refer when I refer to overhead, that is in the context of what I'm talking about. It is going to be before provider. So doctor and associate compensation. We like to see what those percentages are. It gives us a good baseline of where we're at. And then we can look at the EBITDA after the fact and say, okay, what is our EBITDA margin? What is our overhead margin? Overhead in a general practice, if I was in a perfect world and all the dentists I work with, I would want to see them at 60% or less. That is an extremely profitable practice that's going to do very well. Um, excuse me. In today's day and age, with increasing costs, a lot of the things we talked about, pressure from insurance reimbursements, um, we still shoot for 60, but we don't want to be above 65. Once we get to that 65% overhead, we start to see a squeeze on cash flow. So it's really, those are really the things I talk about with the EBITDA and the overhead. But an EBITDA margin of 20 to 35% is going to be very good. Collection rate, we want to see this as high as possible. Definitely in that 95 to 98% range is ideal. Obviously, we want to be able to collect everything, but it is, it's not reasonable to think that we can. So as long as we're collecting that 95 to 98 range, we're going to be in pretty good shape. And I think one other thing, it's not on this slide, but I always like to talk about it. Obviously, we want to be looking at the overhead ratios. Those help us do, some expense management, some cash flow management, know that we're spending money in the right places and that we're being smart with it. The other thing I think that's really important, so not only looking at expenses, but talking about, the collection and the production number. I think most offices I work with have some type of a daily or weekly or monthly goal. I think if you just have a monthly goal, it's almost too big of a picture to be able to really hone down and meet that goal at the end of the month. So I like to talk about daily goals, get down to that micro level and really help a practice hone it in and have specific goals to be able to meet those bigger goals at the end of the month or the end of the year. A couple of those things we talk about, $900 of production per hour is a good benchmark for a daily goal, or just a daily goal of $4,500 is kind of the minimum in terms of production collection. If you have a higher goal than that in a general practice, that's fantastic. But that minimum, kind of that minimum of $900 per hour, a minimum of 4,500 per day, hopefully more than that, hopefully closer to that 5,400 or $5,500. But I think what's important about all these things, that kind of went off on a little tangent intentionally. What's important here is that you are measuring something. You have the ability to measure, you're managing it. It's only going to give you more exposure, and you're going to have more opportunity to make improvements. It's hard to make improvements when you don't know what you're actually looking at. I see a few items popping into the Q&A, so I can go ahead and answer some of these. Oh, are these eligible for CPE? I don't think so, unfortunately, but thank you for your question. And what type of practice is 900 per day? How many dentist hygiene? That's a great question. That's going to be a solo office. Minimum of 3 hygiene is going to do that $900 per day. So that's something that we talk about there, usually around that 900. So I'll try to keep an eye on the Q&A best that I can throughout this. I'm going to work through things through the slides, and then if I don't get to them at the end, we'll definitely go back through them if we have additional time. So next slide. Um, Shifting from the overhead and profitability conversation to let's talk about taxes. Those 3 things that we kind of mentioned on the front end, overhead being one of those, tax being a big piece of that. Tax preparation, so the tax return itself is a compliance requirement. Like, you need to file your taxes. You have to file your taxes. So these are all historical reports. These are reactive. They are not proactive. They're all completed after the year is over. If a decision was made in the past year to buy something, or you end up collecting something that you weren't expecting, those items are gone. They're in there. They're baked into the numbers, and we're now reporting on historical values. Tax planning is very different. Tax planning is forward looking. We're looking at strategic opportunities. We're looking at ways to save money while trying to keep as much of the money in our pocket, and just use those dollars efficiently. So not waste them. Have a strategy for how we're going to be reducing our tax dollars. Another item we're going to talk about, entity structure. So making sure we optimize what kind of entity we have. So this could be anything from sole proprietorship, LLC, S corporation, partnership, or some type of multi-entity structure. So we have a lot of options there in terms of potential structures. But really, why would we even be talking about all these different ways of structuring your practice? We're looking for benefits within those structures. So you might switch to an S corporation to help with the self-employment tax reduction. You might be looking at different types of LLCs for asset protection. Some of these multi-entity structures, being able to move income to different entities. But really, having the proper structure is going to optimize really what's that succession plan generally going to look like, and how are we efficiently using dollars today. So A little statement down or an example down below. So, dentist netting 500,000 annually may save tens of $1,000s for proper compensation and entity planning. That a lot of that's in that self-employment planning, or we've structured ourselves in such a way to be able to take advantage of things like the qualified business income deduction. So those are all things that you know, as part of this tax planning throughout the year, the entity conversation does come into it. Not every year. A lot of times that's generally on the front end, but it's definitely something we'll be in discussion. Retirement plans. So throughout, this whole webinar conversation is all about what are the best practices doing to maximize that cash flow, maximize all of their opportunities and benefits throughout the year to make sure that they're using their cash efficiently and doing things to the best of their ability. I personally am a huge proponent of retirement plans. I think the retirement plan is your most powerful opportunity within a practice to not only save money, but generate wealth for even after you're done practicing. Couple of options that are out there, and there's a few that are not included on here, but I would mention them just briefly. There's something called a SEP, an SEP. If that conversation comes up, it's generally not the right option for your practice. It's expensive in the sense of the contribution amount to make to employees. So if you want to make a contribution to yourself of 20% of your compensation, you have to match that in your employees. So it is still an option, but not one of the better options for a practice. Another is a simple IRA. Simple IRAs can be great, but the amount you can put away in a year really doesn't meet the savings goal that I would want for you. So, really, when we talk about the best options, we talk about 401k, we talk about 401k with some type of safe harbor added to it, a profit sharing component, and then very special tool, something we'll spend a few minutes on that gets added on top of a 401k is called a cash balance plan. Um, and so with a 401k specifically, we can save if we plan things the right way with compensation, knowing what the employee demographic is and giving ourselves the ability. The doctor within an office, a solo office can save as much as $70,000 per year in contributions to their own retirement plan. Um, 24 plus thousand of that's going to come from deferrals, which is your W-2 wages. Then there's the safe harbor component. And then there's the profit sharing component. Those three things together can be added to get you to $70,000. Now, practices who are later on in their dental life cycle, I would say, so not these really new practices where there's still debt payment obligations. I'm talking about practices that have been around, been practicing probably 15 to 20 plus years. Overhead is dialed in. They don't have any more debt on the practice, or at least very little debt on the practice. So there's significantly more cash flow. And when that happens, generally that means taxes will be higher, right? You don't have the interest deductions anymore. You generally don't have the depreciation from the dental equipment and other assets that you have purchased, the goodwill. Those things have all ended at that point after 15 years, except for new equipment, obviously, that gets purchased. That's where this cash balance plan comes into place. With proper planning, and from my own personal experience, and one of my favorite experiences as a dentist was in a small town, very low overhead, very, very profitable practice, paying hundreds of thousands of dollars per year in taxes. We went in, talked to them about a cash balance plan. All of a sudden, they were able to save $1 million in retirement in a 5-year period. That does not happen with a 401k. That happens with a cash balance plan. Again, I don't want to speak too much of the actual ins and outs of a cash balance plan, but you need to have an actuary. It's a little more expensive, but isn't a significant planning tool for later on and getting more dollars into a retirement plan. So why are these beneficial? You have immediate reduction in taxes. It's protected, obviously, and you have long-term wealth accumulation. And that's why I think the 401k is probably the best tax saving strategy is yes, you're getting that immediate deduction, but those dollars aren't going anywhere. It's not like we're writing a $50,000 check to a supply company to reduce our taxes or buying a piece of equipment we don't need. Those dollars are going into a bucket that you will then be able to tap to later on in life. So that's why I think it's the best planning tool. Another planning tool a lot of offices use for those offices that own their real estate, a cost segregation is extremely beneficial. Really high level, what this essentially means is when you buy a building, the IRS says that the building needs to be split between land and building. That cost that is split to the building is depreciated over 39 years, which is a very long time. And that deduction is not significant in any given year. So you could be paying a significant amount of rent to your real estate entity. The interest is there to offset it. The cost base of the building divided by 39, you get that each year, but that's not a lot. You could end up with some additional tax on that income that's flowing over just because of the differences between principal payments made and other items. So what a cost segregation does is it takes that building and is going to give you the ability to accelerate the depreciation into different tax lives. So equipment, 5 years, potential land improvements or leasehold improvements, 15 years, um, office equipment at 7 years, and then you have the remaining portion that gets allocated to the 39 years. So it's breaking down the components of the building into shorter lives so that we can take these depreciation benefits more quickly. Um, that's going to give you tax savings, and you don't, I mean, you're already paying for the building. So there's the benefit there. And now you have an asset that is going to accumulate wealth in the form of real estate and give you some accelerated depreciation on the front end. So cost segregation is a great planning tool. We talked about equipment purchases, and I feel very strongly about this because certainly are some benefits. You have Section 179, which is immediate expensing of the cost of the asset. Bonus depreciation. Right now, we're in a 100% bonus depreciation environment, which means you also get to deduct 100% of the cost in the first year. They have different results. 179 cannot create a loss. Bonus depreciation can create a loss. So different things that can happen there, but at the end of the day, they can have the same result in terms of a reduction to income. But we really want to be smart with this. And so when I hear this specific question, and I do hear it, how much should I buy before the end of the year? I will always come back and say, do you need anything? Is there anything that's going to make you more profitable, more efficient, or make the practice better? That is a better question. That is a question of we're making an investment instead of just letting the tax tail wag the dog. Um, I don't love the buying equipment just to buy equipment. And a good example in a brand new practice, somebody walks in, they acquire the assets of somebody else's practice. So you buy the equipment, you buy the goodwill, you buy the patient records, these things that you buy when you purchase a practice. Um, those items in the first year, some of them can be depreciated right away. But I would also argue that in the first year, that's probably the least profitable year in your practice's life. Not all the time. You may come right out of the gate and things go really well. And maybe we do want to accelerate some of the depreciation on dental equipment and office equipment, dental supplies, things of that sort. But there is also a time and place to be effective with that money. And so a lot of times, we talk about smart tax planning. There's a lot of times where I may not take bonus depreciation or Section 179 and spread those assets out over a 5 year period, which is how long equipment is generally depreciated. Now you're looking at deductions for the first 5 to 6 years of a practice, which is more closely going to line up with this new debt you just accumulated in the practice. And one of the biggest issues that I see is in a practice's life, they get to that 7, 8 year period, they have no more depreciation, and they have significantly more of their debt obligation going to principal. That principal payment is not deductible on your profit and loss or against your taxable income. What was deductible is the assets that you purchased. So when those things, when those items are used up, that's generally when I get this discussion of how much should I buy before the end of the year. We can be smarter about that depreciation in the first 4 to 5 years and accumulate deductions when as income is going up in a practice. And then that way we're not in this issue of we used all our depreciation early and then we had tax liability and now we don't have enough cash to cover the tax liability for this year. So when I talk about equipment, I really do focus on the return on investment first and the tax benefit of it second. Is there a time and place for buying new equipment and taking it 100% of it? Absolutely. Is that always the answer? No. We want to be efficient in in this decision making. I talked about this in one of the very first slides. Um, Cash flow does not, or excuse me, revenue does not necessarily mean cash flow. Um, you know, just a moment ago, I talked about taking depreciation too early. And then later on, you have those principal payments that are going to the debt. It's significantly more than the interest. You're on the back end of that loan. And, with, any loan, interest is weighted on the front end as the balance is higher, and then it slowly reduces over time. So that is when we need to be smarter about cash flow is later on in those years. And, some of the common cash flow drains, obviously not having adequate reserves, poor debt structuring. This is a perfect example of taking depreciation in the first year, but yet financing a piece of equipment over 5 to 7 years. We have the benefit in year one, and now you have 6, 7 more years of payments with no deductions related to it in the form of the depreciation. So we try to be smart about that. And I would always recommend you have an operating reserve, you have a reserve for taxes, you have a reserve for equipment if it's necessary, and you have a reserve for potential expansion. So leasehold improvements. Maybe you have a room in your building that could be a fourth, fifth, sixth operatory, and you're just waiting, for further down the line when you're prepared for that. All of these things, I think it's extremely important. But just to re-emphasize, your profit and loss is not going to always mean cash. If you have $100,000 in income on your profit and loss, your cash may only be up 40, 50, $60,000 because of principal payments, distributions that have been made, other things related to that. But it is really important to understand that the profit and loss is not the same as cash flow. They are related, but they are not the same. Um, so when we talk about profitability and looking at opportunities, one of the big things to increase profit is, and we talked about this in one of these very first slides. We've got to know our overhead, and we have to have a method for improving overhead, which then has a significant impact on the cash flow at the end of the day. So staffing's a really good example. Making sure we're scheduling efficiency. That's where those daily goals and hourly goals can come in. You know, do we really want to be open 5 days if that Friday we work for 2 or 3 hours and nothing else happens, but we're there the entire day? That's a really inefficient use of scheduling. So we want to make sure we're scheduled efficiency. We're controlling overtime. We're not spending extra on unnecessary hours. Doing that compensation analysis, knowing how much, if I need to give my staff a raise, what's a reasonable amount? What other benefits are we offering them to maybe counteract an increase in an hourly rate? Because that is a big thing. Once you increase that hourly rate, it's not a one-time increase. That increase is there every month into perpetuity until you potentially do it again. Supplies, big one. Using good vendors, getting bulk discounts, making sure you know what you have and what you actually need, not spending money just to spend money. Insurance, not necessarily reduction in overhead, but can improve those overhead percentages. Are there negotiation opportunities? um, what to take and what not to take. Do we take every insurance? Do we not take insurance? You just go strictly fee for service. These are all things that affect what that overhead percentage is. And then technology opportunities, any automation opportunities that are available to you, whether it's in new equipment, generally are going to cause efficiencies and can reduce overhead. And how I kind of equate this, if you have a practice that is collecting $1 million and we are able to help you reduce your overhead by 5%, that is $50,000 of additional cash flow. It's simple math, but it makes sense. It is a huge benefit to having your eye on the overhead and looking for opportunities to make improvements. Um, So building enterprise wealth. Um, we talked a little while ago about um, buying a practice, the depreciation that's involved in that. If you don't have a practice um, and you're looking to buy one, it's always about overhead. It's about collections, about what am I going to pay for it? Um, what's the condition of the equipment? Can I buy the building? These are all really simple questions that when I talk to buyers to find a practice that could be a good fit for them. Now, in reverse, if you're looking to potentially sell or you're headed in that direction of I might be a seller in the next 5 to 7 years, well, what drives practice value are all the same things that I mentioned when I talk to buyers. So, higher EBITDA. So, you have profitability, your overhead is in a good place. Um, generally in a doctor comes in, is buying a practice from another doctor, it's going to be a percentage of collections is really a good rule of thumb of how we look at value. We also look at overhead. We kind of adjust that percentage based on the condition of the practice, the equipment, the overhead percentage. Can you buy the building? Like we're looking at all of those things as potential benefits. Now, we're talking about a practice, and I work with a lot of practices that have 5, 6, 7, 8 different locations. When you get to that level, the percentage of collections is no longer as much of a conversation, or if any conversation at all. They are looking at EBITDA. So in a large practice sale, it is entirely about EBITDA. So what are the earnings of the practice after everybody has been compensated, but not including interest, taxes, depreciation, and amortization? So that drives value in larger practices. What drives value in a smaller practice? Really similar. We want good profitability. We want high collections. We want good equipment. Those things drive it in a smaller practice. In a larger practice, it comes entirely down to the profitability of the practice. And that the better that profitability, the better multiple you're going to receive. So whether it's 6 times, 8 times, and that creates that value to where somebody can come in, buy that group of locations, and you can and everybody wins. So looking at EBITDA for large practices. So both those two things talk about succession, that succession planning. How am I going to exit? Is this going to be a sale to a potential associate? So internal sale, associate buyout. The larger practice scenario, that's that DSO transaction that I talked about. Is there a potential for family succession? So are one of the kids going to be coming up and working in the practice and then potentially buying the assets or the stock of that practice? Or finally, what is most common is a third party sale. You have dentists who went to dental school. They go out, they look for a practice, they find a practice either through a broker or through a friend. They know somebody in the community that's selling their practice, and then you buy the assets of that practice. Um, So for those that are looking or that are the potential seller, where where they do the best, so where those best practices perform the best are in the things that we talked about already. But when you are exiting, what do you need to think about? So, what you need to think about if you're in that 5 to 10 year window where you're preparing for practice sale, we need to be thinking about how we can mitigate some of those taxes. Really simple, easy example, you sell the real estate and the practice in 2 separate years. Try to break out so we're not putting two sales into the highest tax bracket possible. For the practice, we want to maximize the value of that practice. So again, if it's a solo, collections, overhead, uh, you don't need the most up-to-date equipment. It just needs to be in good condition. A brand new asset purchase does not increase the value of your practice as you might think. But having updated equipment, it doesn't become one of those things where you walk in, it's like, oh, I have to replace that vacuum or I have to replace this milling machine. Having that at least newer and up to date adds value. But just buying it does not increase that value right away. You're not going to see a one-to-one return. And then obviously most important with preparing for exit is going to be is going to making sure you have the retirement in place. So whether it's using the 401k, do we add a cash balance plan? Do we have opportunity there to increase value? So here's kind of a little checklist that I've put together. There's a couple of items on this list we haven't even discussed yet, so I'll take some time. But this list is what the best practices that I work with are doing every single year. And they do not skip a year. It's not something where they do it one year and then don't do it another year. They are doing these things every single year. So they have their retirement plan, they're maximizing their potential with their deferrals, their profit sharing. Um, they're doing an entity review, at least to make sure that are we in the right situation. Um, right now there's a lot of discussion around state taxes and what are deductible and what's the right entity to be able to deduct those. And so, within that entity review, there's self-employment tax mitigation. There's different strategies. You might want a partnership if you have multiple owners, so you have the flexibility of the flow of cash to them in terms of compensation, distributions, income allocations. So it's important to do that entity review. We talked about the cost segregation. We talked about equipment planning. One that we haven't talked about, and I'll spend a minute on, is family employment strategies. So employing your spouse in the practice, having them on the retirement plan, having them with a specific job function so they have the salary there. It's just additional wealth accumulation in the form of the retirement. They don't need to be making a significant amount. In fact, more payroll taxes, there's a better way of handling that. We really are doing that with the goal of accumulating additional wealth through retirement planning. Kids are also a huge opportunity for compensation planning. A lot of practices that have their kids employed in the practice, they have a job function. They're doing cleaning, they're doing filing. They have something, they have an hourly rate, and they're making enough funds to maximize a Roth IRA. And why is that so important? If they make less than the standard deduction, now leave the state side out of it because different states have different rules of what their standard deductions are. But from a federal level, they make less than the standard deduction. They pay zero tax on the wages that they receive. You have a little bit of payroll taxes, absolutely. But if you can make over the $6,500, $7,000, you can max fund a Roth IRA. And I have numerous situations where kids, by the time they're through college, have more than 150 to $200,000 in a Roth IRA with the growth. So there's potential, huge potential there for wealth accumulation. And those Roth IRAs are great planning tools. They're great opportunities. There's things you can do with those other than just have them for retirement. Accountability plans, this is really what accountability plans refer to as proper reimbursement. So, mileage reimbursement, reimbursement for the use of your home for business. So whether you have continuing education events at your house, or maybe you do a company picnic there, that's what accountability plans are referring to. It's really having the proper reimbursement structure in place so that you can take advantage of things that are deductions that you may not always think about, but are certainly a benefit. HSAs, I'm a huge fan of them. I have one myself. I fund the HSA. It can be invested. I had a colleague who actually told me a story just a few weeks ago of somebody who they knew who max funded their HSA, never touched those funds, and had over $500,000 accumulated in that account when they got to retirement. That is basically long-term care planning. They're not going to have to spend a single dollar in medical costs, potentially not have to spend a single dollar in medical costs because they optimize the HSA. There's a huge benefit there. The other thing you can do, you can pull funds from it tax-free. You can go back into your bucket, take a medical receipt. So I'm in my 60s. I have a medical receipt from a few years ago. I can use the HSA funds to reimburse myself for a receipt, even if it didn't happen in the same year. So there's huge benefits to the HSA. We talked about the real estate ownership. If you can buy the real estate, I will tell every practice owner to buy their real estate. I think it's a huge benefit. I think it should be done, and that's where the cost segregation comes in. Succession planning, know the value, know what your overhead is, be smart with practice decision making, and be prepared when you are ready to retire and sell your practice. Quarterly strategic planning meetings, and I'm not overemphasizing this. The best practices are doing this. All of these things on this list, they are doing them, with maybe an exception to a few that they don't do because it's not the right fit. That's fine. But doing quarterly planning, I think, is extremely important. You're being proactive. You just know where you're going to be at the end of the year. And there's always fluctuations throughout the year. There's going to be quarters that are going to be better than others. There's going to be times where the practice is going to be in better financial position than others. But you don't know that without doing that planning and understanding how those different times fluctuate. So again, this is a checklist. If you're not doing all of these things, it doesn't mean you're doing a bad job. It just means there's room for improvement. So have a little quick case study. So collections, and this is more of just like kind of talk about what is quick case study on proper planning. So this is a general dentistry practice that's collecting roughly $2 million. They have profit of 500,000. So there's your EBITDA margin of 25% that we talked about earlier. In this case, they're in the highest federal effective tax rate, which is in our current tax law is 37%. If they are able to find a 4%, or I'm sorry, $40,000 reduction in overhead, that's only a 2% decrease. So not a lot. 40% reduction. And then maybe we include we add a profit sharing component that increases their retirement plan deductions of 120,000. So we have a 40,000 or $120,000 outlay for the retirement, 40,000 of cash coming in because we were able to find overhead reductions. The effective rate of those two changes is a $35,000 tax savings. So we've increased our annual cash flow by $75,000. And what this basically assumes is that $120,000 retirement plan deduction, that's going to yourself. So it's not necessarily gone. It's still there. It's just in a bucket that we're going to use later in life. So having proper planning, and there's an item that I didn't even include on here because I was concerned with how complicated we could get, but I want to mention it. If we have the ability to plan effectively for what's called the qualified business income deduction, and so that's something we have right now that we've had since 2018-19, and will continue for the next couple of years. If we can effectively plan and get our income to a level where we qualify for that deduction, it is an additional 5 to 10% tax savings just by being able to get that deduction. I'll use a really simple example that when I talk about this with dentists in these planning meetings, If you are sitting right around $500,000 of taxable income, you are roughly $50 to $60,000 over the limit to where you qualify. And the reason I say over is because dental, attorneys, CPAs, healthcare, we are four of the industries that has a phase out to this deduction. We will lose the deduction if our income is too high. So if we can effectively use retirement plans or equipment purchases, might be a time to do that. So we're being more tax efficient with those purchases. If we can get ourselves into the range where that deduction is available to us, it is 20% of the profit of the practice. So in this case, this 500,000, if we could, and 500,000 is probably not a good example because it's over the range, but let's say we're at 300,000 in practice income. If you're fully in the range and you can take 100%, that is an additional $60,000 deduction that you had to pay nothing for. So that's the reason I mentioned that, is just to overemphasize how important it is to do planning and be aware of where you are at and look for opportunities. So kind of getting to the end of our webinar here, the most successful practice owners, and I think I've hit this a bunch or several times throughout this conversation already, but they're tracking their KPIs, their benchmarks, they're looking at those. It doesn't have to be monthly, but it certainly is benefit to being monthly, but at minimum quarterly. So they're doing that tracking. They're planning for taxes year round. They're at least having that conversation to know, what should I be prepared for, and what decisions can I make now to be more tax efficient? Third, optimize retirement strategy. So 401k, safe harbor, cash balance plan, potentially, right? But at least profit sharing, having the right idea of what does my compensation need to be so that I can maximize my potential for retirement plan savings. Um, Evaluating entity structure regularly. I'd throw the real estate piece into this one as well. Like, what are we doing with that interplay between real estate and the dental practice, and how do we improve on that? And then finally, focusing on that enterprise value. What is that practice value? How do we maximize that, whether it's increasing production, reducing overhead? Do we have multiple locations now? We're looking at a bigger buyout where we're looking at an EBITDA. It's just important to keep an eye on all these things. And so final thought, it's not what you produce, it's what you keep. And that's what I talk about that a lot. We're trying to make the best decisions we can so that you can keep more money in your pocket. So with that, a couple of quotes here to kind of finish up, but I just want to say thank you to everybody who joined today. As it says here, the average dentist focuses on generating income because that's what they went to school to do. They went to school to do clinical dentistry. The most successful dentists, though, are focusing on converting income into long-term wealth. That practice is an investment, and we want to maximize our return on investment. So thank you for those that joined today. I do believe maybe we have one more comment in the Q&A, which I'll take a look at before we sign off here. What topics, questions that are a must in your quarterly meetings? Overhead is in every conversation of my quarterly meetings. Retirement planning is in those. Are you going to hit your deferral maximum? Really, a lot of the things I talked about in this webinar today, those come up in almost every quarterly meeting. So overhead, compensation planning, not so much the entity structure piece, but equipment planning. What's the trend in terms of collections? Are we seeing a specific cycle where maybe there's a month or two where it's, oh, that's our low month? Or, depending how you compensate your employees, understanding that there could be a month when you have 3 payrolls versus your normal 2 payrolls. So those are some of the general topics that we cover. But thank you, everybody, for joining. That is going to conclude the webinar for today. I think on the final slide here, I do have my contact information. Yep. So if you ever want to reach out, if you have questions, you want to learn more, about some of these strategies, dig a little deeper into it, since this was obviously a high level discussion, feel free to reach out to me at Sorren, and my email's up there and our website. So thank you again. Appreciate you all.